Volatility is not a pit, it's a ladder. The VIX goes up and down, but contango losses are forever. Volatility is not a pit, it's a ladder. The VIX goes up and down, but contango losses are forever. Volatility is not a pit, it's a ladder.
All right, and welcome, folks. Thanks for sticking in there with me. I just got this new microphone and trying to get it together. Wow, I'll tell you, what a day. I hope everybody survived okay. This is the market when it's not going straight up. This is what we call vol. This is where the opportunity is, but it can also be a really scary place if you're not ready for it. It felt a lot like, after that news came out, it felt like everybody's fear was, oh no, we could go to negative on the day. And sometimes the market has a way of realizing whatever your fear may be. And I think that's kind of was the case in this time. So let's take a look at some stuff here. Let's pull up, Let's pull up some stuff here. Okay, so this is a chart of the VIX over the last while, but let's go to the daily chart here. So, okay, so this is what the VIX did today. And as you can see, huge sell-off on the close. Let's see if I can get my picture in here. So yeah, I just got this new microphone, so I'm very excited. On the close, we had that spike, and you can see that's due to everything selling off. So if we look at the chart for the E-minis, you see it sell way down and off. Now, this is scary stuff, but for my buddies out there that trade UVXY, everybody had a chance today to make some money if you were willing to actually trade and execute in and out. So let's look at UVXY here. So here's the action on the daily for UVXY. And you see it basically selling right down into 2 o'clock. And, we knew something might happen then. The news came out, as sometimes does happen. When minutes come out, sometimes it takes a while for people to actually read them, because you actually have to read them. So people that are smarter than me, maybe not smarter than you, but smarter than me, have to get the notes, read them, and then there's a reaction that's a little bit delayed. Now, of course, that's not to say that reactions necessarily are going to make sense to us anyways. I mean, it could be sort of great news and the market still goes down. It can be hard to predict. That's why I don't try to predict it. However, we did make progress today as far as, I think of myself as a volatility short type guy, and we did make progress today. And the reason I say that is over here, if we look at the VIX today, even with the E-minis down 17 currently, let's see actually where the E-minis were on the close. So E-minis somewhere right around here on the close, but even with E-minis down, the VIX was down over 0.5 point overall today, and the futures were unched to slightly up a little bit on the day. So that means that these two things are converging with each other, and that's what we want to normalize the term structure. Now, what do I mean by when I say normalize the term structure? Well, let's take a look for a second. let's take a look at what the term structure looks like right now. So I'm going to pull up my favorite spot to look at the term structure, and that's VIX Central. Shout out to Eli Mintz, who I would love to have on. And let's take a look at this here. So this is fairly typical of what we've been seeing for the last couple weeks as far as a term structure. We have the spot price up top here, and everything else way down below. The relationship of these futures to each other has been bouncing around a lot. You saw it in a really weird structure all day. Part of that is because some of these farther out futures don't have a whole lot of liquidity. So they're just going to bounce around, and people are not going to really arb them or anything to get them back into line. And as the day goes by, they're going to look a little funky sometimes. But I wouldn't take that as meaning very much because, like I say, they're kind of illiquid farther out. If you were to look at volume figures, you would find that the front month is going to have most of the volume, especially at this time of the month. So with the term structure here, every day, several of these volatility products are selling some of this front month future here, the March one, and buying the April one. Now, they might be doing it in different ways. They don't all do it at 4:30, and they might be using other products to do so. But the end result is it's going to pop up somewhere in the term structure here. Because even if they're using other products, the people who are trading those other products are gonna lay off whatever their exposure is, and it's going to be represented in the term structure here. So what do I mean when I say normalizing the term structure? Okay, well, this is not a normal term structure here. Now, let me show you how this works, because we can go here to historical prices, and we can go back to, say, January of this year. So let's look at January of this year. Um, 2018 and January. Let's just pick a day. So January 17. All right, so here's January 17, and well, what does this not show? This doesn't show where the spot was. So quick look back at our Thinkorswim, and we can find where spot was. So if I extend this out here to 90 days, let's see, 90. Then I can look at and see, okay, so January 17th is right around here. So spot was right around, let's say $12, $12.50. Okay, so spot is right around here, right? All right. I just messed it up. Hold on one second. All right, well, I just messed that up. But anyway, I'm going to get it back to where it was. You'll notice that when we look at this structure, that it is sloping upward as you go to the right. And that is what we would call the futures in contango. And I call that the normal structure because futures are generally in contango. I think the stat is about 80% of the time, or 80 to 85% of the time. So I'm going to struggle to get this. Let's see if we can do this. All right, we'll do it the old-fashioned way. Okay, so January 17, this is what the term structure looked like. And the line was of where spot was below all the futures. That is what I call it a normalized structure. I call that the normal structure because that is where what the futures curves looks like about 85% of the time. So if we were to take a pen, we could draw a line here. This is pretty much where spot was. Under here, that's supposed to be a flat line. So a spot was, let's say, 12, 10, something like that. And the curve slopes upward. That's what usually happens. And so then every day when they roll, they're selling a cheaper future and buying a more expensive one, and that gives advantage to the people who are short. But right now, and the reason why there's an advantage to people that are short in this situation is that A, when they roll, they're buying a more expensive future and selling a cheaper one, and B, these futures are always falling downwards towards the spot. So in this situation, the futures are always falling downwards towards spot, with spot being like down here. So if we were to go back to go back to today's chart, now we see that the pressure is to the upside now because the futures are below spot, and so there's pressure for these two to converge. And as we get closer to expiration, this front month future will converge with spot. And you notice right now there is a $1.40 difference or a $1.42 difference between the front March future and spot. That amount got down to 0 earlier today, but now it's gone back to where it was because of this spike. So we made a bunch of progress, and then we sort of gave it all back today. So structure goes, we have some bias to the upside. Conversely, we do have some beta slippage, which occurs when they have to rebalance to try to see every day they try to make this replicate 2 times leveraged to the upside and 2 times to the downside. So they have to rebalance every day by either buying or selling futures, and doing that causes some slippage at times. I do want to discuss for a second. Let's go to the ProShares website and take a look at the composition of UVXY right now. I like to look at this to remind me of the composition. So we can see here, I'll put my head in the picture for a second. So we can see here that the top line there says S&P VIX Short-Term Futures Index Swap. Now, that wasn't there a month ago. That's been there for a couple weeks now. And what does that mean? Because this is an ETF, and we know that the difference between ETFs and ETNs is ETNs can be more creative in how they replicate their particular index, whereas ETFs have to use the underlying securities. But this one is an exception. It has in the prospectus that they may use swaps at times. So what does this swap do? We can see here it shows notional value. Actually, these swaps are the biggest component of UVXY right now. Then we see some of the March future and some of the April futures. And we can see that it's weighted toward the March futures, which makes sense because we're sort of still in the beginning of the cycle. But what do these swaps, how do these swaps act? Well, let's take a look. So these swaps can act in one of two ways. And I'm not finding my documents. Hold on one second here. That's okay. We can do it without documents. These swaps can act one of two ways. One thing they can do is they can just replicate one of these futures. So they can just say, we are creating a product that's going to act exactly the way the March future acts. And it'll be a substitute for the March future. And we're just going to guarantee that whatever that does, our product will do. And that's what Société Générale. Société Générale is a big French bank that is known for making markets and swaps. And they're basically, when they're selling these swaps, they're essentially selling volatility. This can be an attractive thing to do because volatility is now up off the floor and in an attractive range where certain entities want to lay off some volatility. And so the reason that UVXY would do this is because they're going to get a better deal doing this swap than they would with the futures. So it doesn't tell explicitly how this swap operates. So there's two possibilities. One possibility is that it just replicates a future. So it could be March or April futures, and it just replicates it exactly. Another possibility is that it replicates the overall UVXY, and so it changes every day to be composed, to replicate a composition of part of the March and part of the April futures. So as UVXY rolls, the composition and what this swap emulates rolls. So you can make a swap to be anything you want. It's kind of like in the options trading world, we had leaps where you can make up your own option strikes, series, expirations. And a lot of times in the options world, people will use these kind of setups to do risk collars where they're protecting, let's say they're long some sort of shares of a stock and there's a lockup period, so they're not allowed to sell them for a certain period of time. So people want to lay off the risk from being long, so they will essentially buy an out of the money put and sell an out of the money call. And a lot of times people want to do this sort of collar for zero cost. So they want to pick strikes so that even including a skew, the call price is equal to the put price. So it costs nothing to put on this this collar. But in this case, they've made a product to help replicate UVXY. And don't be concerned about it because it's going to operate just like UVXY did before, and it's not risky or any more risky. It's just it saves the company money, and that's why they do it. So let's go back to the markets for a second. And let's try to take a look and sort of sum things up here. So the minutes came out, and they basically said that, well, they basically didn't say a whole lot, but people gave a dovish analysis of it. The minutes were from a meeting that was before that February 5th sell-off. And I believe it was also before the tax legislation had gone through. So neither of those things were being considered during the Fed meeting because they had not happened yet. So in a sense, some of this stuff is sort of moot because it doesn't apply to today. So Jerome Powell took over as the head of the Fed recently, and somebody on CNBC was saying that when Janet Yellen would release the minutes, what she would do is she would sort of give an updated view from the Fed for today. So, for example, if Janet Yellen had been doing the minutes, she would actually be discussing in the minutes stuff that had happened between the Fed meeting and now. But it appears that Jerome Powell is taking a different stance, if CNBC is right about this, and just giving the facts, Jack, just saying, all right, well, this is what happened at the meeting, and this is how we read it then. and it was viewed as dovish, but a lot of the commentators said that it actually would be probably more hawkish if done now. Now, what does dovish mean? Dovish means that they're less likely to raise rates, and hawkish means that they're more likely to raise rates or do something. So even though UVXY ended up, right now I'm short UVXY, and even though it ended up a little bit, I still feel like we accomplished something because the VIX was actually down on the day. So, but you know, we're going to see, as long as we see actual realized volatility like it's been, that being stuff moving around a lot, the VIX isn't going to come in all that much because, you know, in the end, if stuff is volatile and moving around, the VIX is going to be higher. Generally, you know, VIX and options prices generally sort of outpace realized volatility by a little bit. We talked about that a little bit with Justin, but if you've got moves like this going on, we're going to see volatility staying strong. That being said, I believe as long as volatility doesn't spike upwards, and as long as we don't continue to make new lows and accelerate to the downside, this term structure, which we were talking about before, will sort itself out so that we're back in contango. Even if we end up in a bear market, I believe that will happen. Now, right now, term structure favors the longs. It's being offset a little bit by sort of beta slippage because every leveraged ETF has some slippage. Sometimes it doesn't work completely right, but so, I mean, sometimes if it moves in a certain way, beta slippage can actually go in reverse. But in this case, with up moves some days, down moves other days, we're getting some slippage. Anyway, thanks for joining me today. Sorry I'm a little discombobulated. I'm just trying this new setup out, and I wanted to talk to you live. I want to thank everybody for coming and joining this new VIX group on Facebook. I will leave links in the description. It's not about me. It's about the people in the group. There's also a new MJ stock group on Facebook, which you can check out as well. There's a lot of different spots that VIX information is coming from. I find interesting stuff on Twitter. I find interesting stuff on StockTwits. One of the things on StockTwits, hold on one second. Hi, Justin. What's up, buddy? Let's see. Yeah, Justin, I can't hear you, but I can read what you're saying. Anyway, yeah, so what I was saying was that we're in contango about 85% of the time and in backwardation about 15%. I guess we can argue over the actual stats. But right now we're in neither because we're still in kind of never land here. Seeing if anybody showed up in the other chat. No. Anyway, so that's where we have it right now. I hope people made money today. And once again, I want to thank people for signing up for the Facebook group. It's just getting started, so I promise the content will be good. I found some very interesting stuff everywhere, and posting to StockTwits can be kind of difficult because you post something that's gone in 2 seconds, and when you find a good article, like there's been some good articles in Seeking Alpha lately, when you find a good article, it just you post it and it's gone. Whereas on Facebook, you can put stuff up and people can check it out when they've got a moment. So I'll just show you the Facebook group for a second. I'll put a link to it, but it's under basically Facebook groups VIX trade. So here it is. And it's fun. Anyway, so I hope this was helpful. I hope the swaps things helped you out a little bit, and I don't want to be too boring. So no possibility to have a voice chat here. You would have to call me on Skype, and then we could do a voice chat. So if you want to call me on Skype, then we could do it, I suppose. I can figure out how to do it. You want to try doing that? Let's try. I'll try calling you on Skype.
Dave.
Hey, what's up, buddy? You want to turn your speakers down there so it doesn't feed back?
Oh, okay.
It's delayed by a few seconds. The playback will be delayed, so it's a little confusing at first.
Okay, how's that?
That's good. I didn't hear you. I just want to make sure you realize that, like, if you look at it, you're going to see it's delayed a little bit.
In fact, I had the volume on the YouTube channel and the Skype simultaneously, and they're not corresponding in time. So I cut the sound off on YouTube, and I'm on Skype with you now. Can you hear me all right?
Yes, I can.
Okay, cool.
Yeah.
So, yeah, that was interesting what you were talking about, the term structure today, Dave.
Yeah, it's kind of frustrating because I thought we were going to get back into a reasonable normalization today, but it didn't really happen.
Right. Yeah, it was a pretty surprising day. I mean, I was going a bit nuts today with the term structure on V2TX, which is, the similar as VIX. It's a VIX on Eurostoxx 50. You guys probably see me posting quite a bit of information there, but it's essentially the same instrument as the VIX, but just the underlying is Eurostoxx 50 index instead of S&P 500. And the term structure there was all over the cap today. And it's kind of nice because it permits you to do a little bit of a statistical arbitrage, because, as you said, term structure, especially in something so organized like volatility, it does sort itself out sooner or later. And today, when you had, I mean, here, can I post a graph somewhere that you can share?
Sure. Yeah.
Okay. Let's see. Where should I post it? In Skype?
I think there's a way to post it on Skype. You may have to save it to a file and then post it on Skype. I'm not exactly sure how it works. You could point this thing at
No, I can get it on Skype, no problem.
Oh, okay, cool.
Yeah, 1 second. File. There we are. There we are. Okay, just posted it on Skype, all right? So what I just posted here is term structure as of several minutes ago on V2TX, which is the European VIX, essentially.
Oh, wow.
And you can see it we just slammed into big well, not huge, but it's significant backwardation across the term structure for several months out anyway. And we started the day in a fair bit of contango, but there were like peaks and troughs throughout the term structure, meaning that it wasn't a regular. So normally volatility term structure will be, as you said, fairly regular. Like normal would be contango, right? And then if it goes into backwardation, it would often be more or less distributed normally, without peaks and troughs all over the place. It would be either like a line going from upper left to lower right, being backwardation, or vice versa, or flat, or it could be a little bit of both in part of the term structure. But what is extremely rare is that it's just kind of random, looking like peaks and troughs all over the place. And that permitted me today actually to when I say arbitrage, I mean statistical arbitrage, not pure arb. So what I did was I would buy the troughs in certain months and then go and sell some more of the closer months, and it was great. It permitted me to hedge out some risk and sell more. So despite the fact that the VIX or V2TX spiked up at the end of the day, uh, doesn't bother me too much because I'm extra well positioned now. I put on some extra cheap hedges and sold more volatility in the front months at a nice high level. So that was quite good. And that was the term structure precisely that permitted me to do so.
Oh, nice. Can you actually put that up one more time? Because my big
Yeah,
picture of my face was in front of it on the screen. Like that little
yeah, sure.
quadrant of the screen was covered by it. But so I saw it, but nobody else did, I think.
Yeah, sure. Post it in Skype here again.
Yeah, that would be awesome. Because
Yeah, sure.
I realized I was blocking it, I think.
Yeah, sure. Up. There we go.
Perfect. Now people can see it.
So, okay, it's not, I don't have the whole thing, but basically the front month there on the upper left-hand side is the March futures contract because March is now the lead month in V2TX or V stocks. V2TX is a ticker, the proper name is V stocks. Then it goes month by month, so March, April, May, June, July, August, etc. So earlier today, for example, what happened was that August was extra cheap and other months were like it was just all over the place. It changed. The whole term structure shifted about 3 times dramatically throughout the day. And it was an awesome day for taking advantage of those big movements in term structure. Even if the overall volatility, which I'm short, finished higher, I'm really not bothered because like I said, it permitted me to put on some hedges at extra cheap prices and therefore decrease my overall margin for that VTTX position and decrease my risk therefore as well. And that permitted me to go and sell even more front month volatility.
Nice. Nice. Yeah, well, I think really what's happening here is that people are not used to there being volatility in the market. And so you're getting opportunities to exploit inefficiencies
Yeah,
because
that's right.
people are getting caught with their pants down in a way because they're not used to having to watch this stuff and try to line it up.
Yeah,
So
yeah.
that's pretty exciting opportunity. I mean, we're always taught that these times when stuff is going crazy are your times of opportunity. It's not a time to turn off your screen and run away necessarily.
Oh, it's a huge opportunity. This is what we live for as short volatility traders. I mean, if you're selling anything, whether it be pizzas, bricks, or cows, or volatility, you want to sell it high, right?
Exactly, exactly. And being short premium, not necessarily directionally, but being short strangles or straddles, it's been great lately because everything's just kind of been whipping around, but we still haven't, we haven't broken the lows that we hit in February 5th, and we haven't broken the high, so we're just kind of range bound. So it's a great time to just be short premium.
Yeah, absolutely. The on specifically on UVXY, the volatility on the options there was crazy high. As you remember, several days ago, we were up at nearly 400% at the money, I believe. 300 or 400%. I don't recall.
Yeah, it was craziness.
Craziness. And if you knew how to deal with term structure in options, which is essentially the same thing as futures, there were some massive opportunities where you could have put on certain option structures with essentially zero risk because of the shape of the term structure and the options on UVXY. So you could have sold, for example, at or near the money at these crazy high volatilities, and gone out in the curve and bought protection for less expensive, which is rare.
But that's always a nice position to have because you're getting paid and yet your risk is covered and you can actually be long Vega in those situations where your Vegas coming from the farther out months being long those. And so if things get even crazier, you don't get killed on the Vega since you are long something against it. So that's a good
Yeah,
spot
yeah,
to be in.
yeah. It was really interesting. Well, the market's still very interesting. I don't think that. Well, I don't know, but uh, I don't think that it's highly likely that we'll see a massive vol spike like we did the other day. It's possible, but I don't think it's really likely. Um, I, you know, according to my experiences, the biggest part of the vol spike is near the beginning of the big craziness, and then people kind of get used to it and say, okay, well, there's no point in buying this super expensive vol when we see that it is, the index is going to jump back up. Maybe it's more nervous or younger traders that start buying S&P options when the vol is at 25. I don't know, but it's just not reasonable to do that very often at all.
Well, the other thing I would really want to caution people about is selling any front week option units at these, because even if
that's dangerous.
even if it says it's a high volatility, you really have to look at what dollar values you're dealing with, and you have to say to yourself, if I'm selling a 17 call for 50 cents, can I envision this thing going through 1750 very easily? And if you can, you just don't want to give away that stuff.
Yeah. I'm actually, I have a little, last time we spoke, I have a bit of a formula, which I'm trying to simplify. Actually, I've been spending hours on it today, trying to simplify a formula that essentially, it's basically a ratio between implied volatility and deltas. So when you're at the money, right, if you have a normal shaped skew, which is kind of a smile looking thing, right? Even when volatility is high, the at the money volatility is usually proportionally smaller per delta at the money than it is further out. Okay? Meaning that you actually get more volatility on the further left and right hand side of the skew than you do at the money. Now, in absolute terms, of course, you get the biggest bang for your buck at the money. But proportionately speaking, as vol sellers, what do we want? We want to sell big volatility. And the higher implied volatility is actually further out on the left and the right hand side of the skew, generally speaking, if you have kind of a regular smile-shaped skew. And here's an interesting thought. We're selling volatility, but the conundrum is that we have to take on risk, and our risk is expressed in, well, to quite simply stated, it's expressed in deltas, okay?
Yep.
Well, ideally, what we want to have is a short volatility position and no deltas. Now, we can achieve that by hedging, okay? But hedging can be very expensive, especially if you're trying to hedge something that's at the money that's really high in gamma, You could actually blow all your money on the hedge and not make it worthwhile. So instead of hedging, which is a very theoretical practice, you can go out wider on the skew where you actually get more implied volatility in absolute terms, and far more implied volatility per delta. Do you follow that?
Yes, I totally do. And when
Here, let me just give you a quick couple of numbers. For example, imagine you have a normal volatility skew. Say the at the money implied volatility is at 20, okay? And say our deltas are 50 at the money. So there we have 20 deltas 20 implied volatility for 50 deltas. Now, if you go further out in a skew, out of the money, for example, on the calls, say you go down to the 20 delta calls, now you only have 20 deltas, but you'll probably have maybe 25 implied volatility. So as a ratio, it's a lot safer to be, dealing with smaller deltas and smaller gamma, and you're actually getting more implied volatility over there per delta and in absolute terms. Do you follow that?
Totally. Yeah, totally. And that's always evident in the UVXY out of the money calls. like you'll see with UVXY at 15, you'll see the 25 calls being worth $1 and the 45 calls being worth 89 cents. You know, like
Yeah,
you're
yeah,
getting, and so that's taking advantage of the skew. Really, is what you're doing with that.
exactly. So what I've been wrecking my head with all day is, I mean, I have a formula that I work off of. It's kind of a rule of thumb formula, but what I'm trying to do is simplify it, and for the purposes of the book that I'm working on, in fact, because what I want to do is transpose this idea into a simple mathematical formula that you can do in your head in about, you know, less than a minute in front of an options chain, and I'm going to accomplish it.
Nice.
Yeah.
Yeah, I mean, I always like to think of things that way, but I also like to think of things as far as can I envision this underlying going through that strike within this amount of time? Think about it just as a yardstick in my head, comparing it with other things I've traded before, which is
Yeah.
it's kind of a feel thing more than a
And
formula.
that's where, you know, one of those quick and dirty calculations. Okay, yeah. That's one of those quick and dirty calculations, just calculating the implied range off of the at the money straddle is very useful to say, well, what does the market think this thing can move by X time? Just look at the value of the at the money straddle, and that will give you a good measure of it.
Yeah, great point. Great point. And sometimes it seems totally reasonable, and other times it seems like ridiculously cheap or expensive. Like, for example, you can look on like a Thursday at the money straddle in UVXY and have it be like $1.50 or something when the thing's been moving around like crazy, and you say to yourself, "Gee, that's a great buy. That's obviously a great buy there. Maybe the volatility doesn't sound like it's great, but if it's been moving $3 a day and you see it being 150 for the straddle, you're kind of like, wow, I don't really want to sell that."
Yeah, yeah, yeah. So you keep in mind, if you're trading either volatility futures or options, the term structure is crucial to look at, notably for locating which part of the skew is really the best deal in town, you know?
Now, what is the symbol for the e-stocks term structure? How do you pull that up? Is it just a special feature of your software you're using right now?
For the VStocks, on my platform, it's V2TX, but if you're in the States, you'd have to have access to Eurex
Right.
markets, obviously.
I was just curious for some of our people that are watching in Europe if they wanted to check it out.
Yeah, just whatever your platform is, just what you're looking for is the VStocks, VSTOXX. VSTOXX, that is actually the proper name for it.
Okay.
And maybe you can locate it like that if you have access to Eurex products, obviously.
But it doesn't work on my screen because I don't have access to that. But
Okay.
but
So you don't have
others.
access to European derivatives, I take it,
Yeah,
right?
exactly.
Okay.
But
Okay.
it's still of interest to me though.
Sure. Yeah. Well, V stocks and Euros, VIX, it's the same animal, just a different underlying. And here I can show you something else that's of interest here. Is it just to show you how they do actually tend to move together, but not in lockstep. So there are, some opportunities there to say, well, one is proportionately less or more expensive than the other. So it can give you some guidelines, Here, let me just get this for you.
You're using the same snipping tool that I use.
Yeah, I just discovered that the other day. It's
pretty
magic.
cool, huh? Yeah, I like it.
It's like I just discovered it, and it's. I just bought a cell phone, by the way. Have you ever heard of a cell phone?
Yeah, I've heard of that. Don't you call it a mobile over there or something?
Téléphone mobile.
Okay. I had a Swiss woman at this job I was doing the other day, so I was speaking a little bit of French. It was very exciting.
Yeah. So there you are. I just posted 4 little charts over there. The upper chart is the VIX futures March. The lower chart is V2TX futures March, and then the two middle ones, those are the VIX and the VSTOXX indices themselves. So you can see that they're extremely similar in shape, but they don't move lockstep. So some guys even do some stat arb trades between them.
It's weird. I can see your snipping tool through the screen, like through the webcam, but the thing you displayed only had 2 charts on it, which is weird.
Huh.
I think it was just the 2 top charts. I'm not sure why that is, but it doesn't matter. We still get to see it.
Okay, anyway, get the idea. Maybe you have to scroll up or down in the image. I don't know.
I don't know. I have to learn how to use Skype a little bit better in the future.
Don't worry about it. It's no big deal. Yeah, so that was a pretty exciting day in term structure, that's for sure. So it was very timely that you discussed that today, Dave.
Well, I had a question about it from somebody. I think people can get very frustrated on a day like today because they see the VIX down 3 at one point or over 3, and they see UVXY only down, or they see the futures only down like 50 cents, and they wonder why that's happening. And the reason that's happening is because the stuff's bouncing around in the term structure. The spot's converging with the futures, and it's not really being illustrated in the futures because they're getting kind of sucked up into the spot. So
that's right.
So even though it's great for us shorts that the VIX was down 3 at the time, it's not translating into the underlying going down yet, but it still is helping us in a way. I try to explain that to people as best I can.
Yeah, and you made another good point, is that the normal shape of the volatility derivatives is contango, and that's simply because I think we covered that during our other conversation, is that insurance contracts with longer dates are more expensive by nature, and if they're not, it's just because there's a storm happening, but the storm is not happening permanently.
Well, there appears to be this appears to be a big misconception on StockTwits, because there's a lot of people who I think remain convinced that somehow things are going to like switch to backwardation and stay there from now on.
That's impossible.
Somehow, if we're not going straight up, it's gonna stay in backwardation somehow. And although I can't tell exactly how the futures move and stuff and how the term structure works, it is always moving back towards a contango situation.
Well, it has to. If it were to, okay, here, just to as a reference, try to understand this, is that if VIX term structure remains in backwardation, that translates into a free hedge for the natural hedgers who have an S&P 500 portfolio.
Right. They can buy the spread. They can buy the spread.
No, not even. Just imagine that they buy, if we're in a backwardated market, okay, and this month they buy VIX futures at 18, for example, okay, and then if they can roll into the next month in a couple of weeks for a lower price, that means they're going to be paying less for their insurance.
Yeah, they can buy the calendar for a credit in the futures, which is
exactly. And if
awesome.
they can continue to do that, that's free insurance.
Yeah.
But as we know, nothing's for free.
Right. So it's going to get arbed out of existence pretty quickly. It is. We have been in backwardation for, I believe, at least some part of the day for 21 days now. So that's longer than we've seen in a year or two, I believe.
Is it 21 days?
Well, I believe it was like February 3rd, maybe that.
Maybe.
Actually, that's not 21 days. That's 18 days.
Yeah, I mean, even that is a little bit long, but it's not a big deal. I mean, it could stay there for a month, or even possibly a month and a half, maybe longer. It can stay there for a little while, but it will still be uh, a relatively short period in the year. That's for certain.
Yeah, I mean, the only trades I've done in UVXY was that I scratched the calls I was short yesterday or the day before yesterday and bought put spreads versus 17.5. And so my trades have gone nowhere since then. I was up a little bit today, but now they've gone nowhere. But I still have 57 days left, so I'm not at all concerned about it right now.
Right, right. No, it's like we know that statistically speaking, VIX is in contango, what, 80, almost 85% of the time, is it?
I mean, that's the stat I was using. I'm sure people,
Yeah,
you know.
it's, it moves a couple of percentage points from time to time, I suppose, but it's still way up there. I mean, it's a crushing statistic. And that statistic is not just, oh, the market was nice during the past. It's inherent to insurance. Like
Yeah.
any insurance seller will only sell insurance if the probability of being liable is less probable compared to the premiums received. So, what would happen if it remains in backwardation? There would be a hell of a lot less vol sellers, right?
Oh, so the chat is telling you that you're out of the camera. Your face is out of the frame.
Ah,
So they want
oh
to
yeah.
they want to see your face more. There you go.
Okay. Here's my dirty mug.
Thank you, SKW Jeff.
Okay.
Well, my godfather works. He worked for a reinsurance company for his career, and what they do is they collect money for years and years and years, and invest it until there's like
Yeah.
a Katrina or something when they give it
Yeah.
all back. And so
That's right.
that's kind of what a short premium, volatility people do. And
Yeah.
fortunately, we were able to sort of sidestep the big spike, and so you know, should be a decent amount of time after that we can do it again. Now, I want you to answer a question which I already know the answer to, but a lot of people have said today. They've said, "Oh wow, SVXY will probably accelerate and shut down pretty soon this week."
That's a ridiculous statement because no fund whose net asset value, NAV, is increasing, why would they shut down the fund?
I know.
Because when UVXY goes up, the net asset value of the fund goes up, and the asset managers are collecting a percentage of that NAV they prefer when it's through the roof. And they're making loads of money, and they're much more happy. The last thing they want to do is shut this down, and there's no reason why it should be shut down. I mean, no reason economically, and no reason in the prospectus either.
Oh, I'm sorry. I think I didn't say it clearly. I was talking about SVXY.
Oh, SVXY.
Yeah.
That I'm not really sure of.
I would say it's similarly. It has to make like an 80% move in one day in the futures again for that to be. As soon as that one day had passed, it resets what it needs to make for a move. So just because it's at $12 now doesn't mean it's like on the verge of accelerating. It would have to go down an additional 85% from $12. So to like
That's right.
$2 or something.
Yeah, I mean, yeah, that's right. Yeah, I don't deal in. Well, actually, I bought 10 shares of SVXY when it crashed, not because I wanted, just because I wanted to see what the hell it does, and what's happening to it. Because I understand what it does according to the prospectus. I just wanted to see if it acts as per the prospectus when it really crashed like that. So I bought 10 shares of it. But UVXY, as long as it goes up, there's no reason for it to close. In fact, because it's leveraged 2 times, the VIX would have to crash 50% for it to be wiped out, right?
Well, SVXY isn't leveraged. UVXY is leveraged.
UVXY, excuse me.
Yeah, UVXY. Yeah, it's 2 times. But the thing is like it's dealing with long futures, so there's no risk on UVXY. I mean.
Yeah, but they're leveraged. So now, correct me if I'm wrong, Dave, but if they're exposed 2 times on the market to what their portfolio NAV is, so they have a notional
Oh,
of
you're right.
two,
You're right. You're right because they have to
right?
sell. Right, they have to sell extra futures as it goes down. So yeah, they do have some risk on it, but
No, UVXY, they're long futures,
right.
right?
Yep.
But they're long twice the notional value of their portfolio NAV, right?
Right.
So if the VIX crashed by 50%, UVXY would go to zero, right?
Correct.
Yeah. So, but I don't think that we'd ever see a 50% crash in VIX, do you?
Well, no, I mean that's the thing is that the danger of the huge move is to the upside, not the downside.
That's right. That's right.
So don't hold your breath on UVXY ever going under.
No, no, no.
The other thing which has been actually widely publicized is just that UVXY and SVXY hedge themselves. It's only the difference in the exposure between the double on one and single on the other in shares. Usually SVXY has more, I think, outstanding shares, but since one's leveraged 2 times and one's leveraged 1 times, as long as they offset each other to a large extent most of the time.
Would they over time? Would they?
Well, it depends on how many shares of each people are buying.
Yeah, yeah. Huh.
It depends, but they do offset each other to some extent.
Sure, sure they do.
Yeah. So do you know anything specific about Société Générale? I was talking a little bit about the swaps earlier.
Yeah, I used to work there.
Oh yeah. Because I've seen them, you know, I tried to Google them and they'd gotten in some trouble about reporting something wrong or something, but
Well, that was one of my first jobs in finance was at Société Générale in Paris at La Défense. And that's the same company that, I don't know if you guys remember Jérôme Kerviel, the guy, the French rogue trader that almost blew the bank up.
okay, I don't remember, but go ahead and tell me.
Well, that was a big story about, I don't know, about 10, or more than 10 years ago, maybe. Yeah, he was one of the prop traders at SocGen, and he put on this massive position. He got called out on it by the compliance officers. He got kicked out, and then when the idiots, when compliance tried to unwind his position, they just did pretty well everything at market in a day or two, which was not the wisest idea considering the massive size of his positions, and caused a loss of like 4 or 5 billion euros to the bank. So,
What was he trading?
what was he trading? Oh shit, it's been so long, I don't remember. I used to know the case rather well. I don't. He was trading futures, I believe.
Okay, so
Futures on what? I don't recall.
a guy on chat says it was 4.9 billion euros, which is what you said, I
Yeah.
think. So there's a question from chat. They said, so if the market makes a downturn, could we assume we will stay in backwardation?
If the market makes it down, no, no, no. What would happen would be the back months rise, and we go into contango again.
Right. If we downturn, if we accelerate quickly to the downside, like let's say
Okay, quickly, yeah.
right, let's say
Yeah.
tomorrow we take out the February 5 lows, we will stay in backwardation, but things will sort themselves out. In any other case, things will sort themselves out.
And don't forget, here's a big misconception that people seem to have, is that when the indices move down, volatility necessarily goes up. Now, that's it's not the case really all the time, because volatility is actually a measure of fear, but provided that it's actually the velocity of the move that counts as opposed to the direction of the move. So you can see increased volatility whether an index moves up or down. It's just depending on how fast it does. And we saw that actually in, the last days of all-time highs in the S&P 500, where we were actually making higher highs, and therefore the S&P was going up, but volatility was increasing. Why? Because the S&P 500 was moving up at a faster and faster rate. and that caused volatility to move up before the S&P actually started moving down.
Well, that was the
Now,
really ugly thing about 2000 is that stuff started grinding lower slowly,
mhm.
and the customer base dried up, so there was nobody really buying anything. But it wasn't a high velocity; it was just kind of grinding lower, and so volatility actually came in as we ground lower, and then
Exactly,
order flow
exactly.
dried up, and there was no way to make money scalping back and forth. So it was a bad
Yeah.
situation.
And so what's going to happen on an index is, well, indices don't fall to zero. So sooner or later, even if they continue to go down in a bear market for years, even the volatility will first of all decrease a bit because people will get used to the environment and not be full of fear. And secondly, it can't continue to drop at this rate, or it would end up being zero in a year, the index, right?
Right.
So volatility on an index, it has to subside to some reasonable level. Because think about it, if you're talking about a VIX at 20, what does that mean precisely? It means that the implied volatilities in the options, in the near the money options in the S&P 500 has an implied volatility of 20. That means that it's implied that the index will move 20% in 12 months. Okay? Now you can only repeat an index moving down 20% per month before you start. You can only repeat that over so much time before the index starts heading towards zero.
Right.
And a large cap, broad equity index is not going to zero or anywhere near there. Or, well, bar I don't know, bar an entire country being blown off the planet by nuclear war or something, maybe.
Well, we started. I remember when stuff started going downhill and we were in a bear market. People had this theory, and you've probably heard of this one too, that the bottom would be when people sort of gave up to the downside, and there was a huge like acceleration to the downside, and people they called it capitulation at the time.
Yeah, classic capitulation. Yeah, exactly.
That's when the bottom's going to be. It's not going to be when it slowly grinds lower. It's going to be when everybody gives up and it accelerates a ton to the downside and then pops up. If it's just kind of
Yeah,
grinding down, that's not the end. And that was like the theory for a long time when we were in the bear market before.
yeah, I recall that well, after the tech bubble, you mean?
Yeah,
Yeah,
this whole
yeah,
capitulation thing.
yeah. So just keep in mind that implied volatility will not necessarily rise even in a bear market. They often do, but bear markets are often rather short-lived, right?
And we haven't reached the threshold of a bear market yet, have we?
No,
It's
well, I don't think so.
I think it's like 20% or something down off the highs. I'm not sure of that though. I'd have to look it up. I should know
Yeah,
that. We should know that, but
yeah. It's just that we haven't seen a bear market in so long. I barely remember what one is now.
I'll look it up. Hold
What's a bear market, Dave?
on. All right, here we go. A bear market. A market that has falling prices. No, that's not it. Hold on. There's a specific definition for it.
Uh, tax.
A 20% or more from a peak in multiple broad market indices over a 2-month period is considered entry into a bear market. So down 20% in less than 2 months.
Okay. And let's see, on the S&P index, we had a high of about 2872. The low was 2532. Oh, we're nowhere near no.
Yeah. Yeah. So
I mean, no. So volatility could go further up. Yeah, of course it can. If it does, we'll just deal with it and make money off of it, or at least position ourselves accordingly. But in any event, backwardation in the VIX cannot last a hell of a long time for a number of reasons. Notably because it's just not the nature of how insurance work. You don't pay more insurance for short-term coverage than you do for long-term coverage, right?
So best guess, if we kind of just kick around like we have been, sort of going sideways like this for the next couple weeks, do you think we would actually, because we were close today to actually being out of it. I mean,
Yeah, I saw that. Yeah.
So we're
Well,
we're
actually,
we're like less than a day away from being out of it, possibly at this
yeah.
point. I
I
mean,
mean, what's a likely scenario if the market continues to trend downwards is that the fix would shift back into contango, not by the front month going down, but by the back months going up,
yeah, yep,
right?
yep. Yeah, it should be led. The structure should go sideways like that, with the back month going up, and then. But the thing is, that stuff's been bouncing around so much that it just can't get there right now.
What can get where?
I mean, the term structure just hasn't been able to sort itself out in the last couple of weeks, just because we've been bouncing around so much. It's only really been a couple weeks though, so patience.
But yeah, but like I said, you can take advantage of this term structure as well because
Yeah.
maybe the VIX is well, I know that the VIX is a lot more liquid than V stocks, but still, I saw some pretty nutty configurations in the VIX term structure as well, and that shows up, of course, in UVXY options
Right.
as well.
So assuming it's going to go back to contango, you can buy the cheaper far out months and sell the more expensive, whichever way it is. So whichever
Yeah.
month, like we saw today, we saw some of the mid-month futures being way cheaper than the ones on the other sides, just randomly. So you buy
Yeah.
the cheap one and sell the more expensive one, and that relationship will go back into line at some point.
Exactly, exactly. As long as you give yourself enough time. I mean, it may not sort itself out in 24 hours, but it will within 50 days.
And you want to look at the dollar values too. Like today, we saw one future being like 17.35 and another being 17.25. That's probably not enough to really put on some big arb or something. But
Well, it's not a question of putting on a big arb and making money, but it's also about hedging yourself. You can find cheap hedges when
right,
term structure gets so screwy like that, you know?
right, right. You can find
So
something to buy to peg the expensive vol you're selling to.
that's right, that's right. And that's what I did on the V stocks today. I've started like, because when it started spiking like that, front months, and then what did I do today? Let's see, just seeing. I was dealing all the way out to August in V2TX futures today. So I bought some August V2TX futures. Usually on volatility futures, I'm dealing, within the first generally 3 months, sometimes 4 months. But today I went all the way out to August, not because I wanted to, just because the opportunity showed itself in August. In the term structure was down like ridiculously low, and then all of the contracts either on the left or the right hand side of it were all up. So I just thought, well, do the no-brainer thing, buy that. It'll reduce my margin, act as a bit of a hedge, and give me some more powder to sell even more front or near months over the next several days if when the spike subsides. Now, I suspect it's going to subside within 48 hours.
And the overall effect of what you're doing when a lot of people do it is it's bringing the market back into line eventually.
Well, yeah, I mean, I'm
Whoever's selling it
essentially
to you.
arbing it.
Yep.
I'm
Whoever's
essentially
selling.
arbing it, yeah.
Yep. So it's interesting. Yeah. Days like today, people who are longs or shorts can make money. You just have to pick your points and be disciplined about it.
That's right. That's right. Just small pieces at a time. Even I'm dealing with a smallish fund, but even for a fund, a couple of futures contracts a day adds up over a month,
Yeah.
Right?
Yeah, definitely.
Yeah.
Definitely. All right. Well, listen. Thank you for coming on.
That was timely talking about term structure today, Dave. Well spotted.
Well, I had an interview lined up, but it fell through, and so I already had my little jacket on, so I figured I'd just come on anyway.
I love your jacket. Just one thing about the swaps you were talking about.
Yeah.
I have no idea why ProShares decided to go into swaps instead of the physicals, but that's interesting. It's obviously for economic reasons, I suppose, because one thing that you didn't mention that is a likely cause is that the margin requirements for swaps may be a lot less than the futures.
Oh, great idea. Yeah.
Yeah, because the futures, the minimum margin requirements are dictated by the clearinghouse, whereas swaps are traded over the counter, OTC, and so it's up to the parties to come to a negotiation as to what the margin requirements will be.
Less
And it's
regulation. Yeah.
yeah, so it's well, it's most certain, obviously, that the margin requirements are less for the swaps than the futures. I mean, just look at CFDs, for example. CFDs are essentially swaps, right?
Yeah.
And margin requirements for CFDs are cheaper than stock, right?
I don't trade them, so I don't know.
Okay, but I'm telling you they are
In
because
general,
the
yeah.
only reason, because you have a bit more security, financial and legal security, dealing with the real thing, in this case the futures contracts on the CBOE, than a swap. Because who's guaranteeing the swap? It's one bank. Who's guaranteeing the futures? Well, the entire clearinghouse,
Right. Exactly.
right? And to my knowledge, a clearinghouse has never gone under,
Right.
whereas banks have.
But I wouldn't worry people I wouldn't worry about that risk if you're trading UVXY
Oh,
of
no, no,
them
no. I'm
defaulting
not
because
worried. No, I'm not putting fear out there at all. And I'm saying it's just the only reason why a bank can go into the business of doing swaps and OTC stuff is if they offer something more interesting for the client. And what's more interesting for the client? Well, they can't really they can't better the prices really, but what they can do is better the margin requirements.
yeah, that's a great idea. I uh, I was kind of scratching my head on some of that, so I had to turn to someone I know that knows more about that stuff to ask about it because I suspected it was just going to replicate one of the futures. But yeah, you can set up a swap with whatever qualifications you'd like. It's just an agreement
Sure.
between you and somebody else. So
Just a contract, yeah,
yeah,
and freely negotiated, yeah.
yeah. So
So,
no
yeah,
big.
what you said is probably right. It's probably a swap on the spread between front and second month.
Yeah. So it acts the same. That way it's not like they have to trade in and out of anything over time. They just leave it on and it's based on a formula. So
Yeah, and then SocGen, they go and do the trading themselves, and then they'll add on, some commissions, but they're asking for less margin up front. And it's likely that, especially now with the volatility spiking like that, we saw margin increases at the clearinghouse for a lot of these volatility derivatives, right? And that was probably what prompted ProShares to go and seek some OTC exposure, as opposed to dealing with getting their margins, requirements through the roof.
well, the other possibility I was thinking of is just that some big player out on the street wanted to sell some volatility and was shopping this around, and they came to them and said, Associated General said, well, here's a way we can package you selling some volatility over the next month that and put the deal together.
Yeah, sure.
It could be as simple as that, like an insurance company laying off something.
Yeah. Well, as you know, for a price, you can do anything in finance, right?
Yeah, exactly.
You saw The Big Short, certainly, right?
Yes, that's great.
Yeah. I mean, when the guy wanted to go short the real estate market, there was no market for it. He just had to pay the premiums, and somebody made him a market.
Right. People will make a market on anything, and you can, if you go on the floor, you can make somebody will make you a market on like high school water polo tournaments or something.
Sure, sure.
Or,
Yeah.
or whatever. So what do you think about? There's been some speculation about this XIV thing. I saw somebody online saying that like, well, maybe some big player came in that day of February 5th and just bought up a bunch of futures, sort of front ran the because they knew that XIV would be needing to buy stuff. They kind of front ran the futures and got up ahead of it and made a bunch of money, and that's why it accelerated. There's a lot of like conspiracy theories out there. I don't really tend to totally believe them, but
Well, a
you
lot of
never know.
fucking crazy shit happens in the world, and I'm
Yeah.
open to everything.
Yeah.
But, extraordinary claims require extraordinary evidence, right? Um,
And a paper
so,
trail. Yeah.
yeah, I mean, yeah, these like a lot of what we've heard lately and seen are regarding these conspiracy theories or whatever. They're unfounded, most of them. just simply because I can see the guys who are talking about it don't know really a lot of what they're talking about. I'm not saying they're stupid. It's just a very complicated business, and if you've never worked on a professional trading floor, and I've happened to have that experience, and also I was on the legal end of things. I used to, I still build structured finance vehicles for my clients in my legal practice, and just not to toot my horn, just to say I know it's very complicated shit, you know, and most people, even the guys who trade it, may not understand all the ins and outs of it, and so these claims I'm seeing are just unfounded for the most part. I'm not saying something shady did not happen. I'm just saying I've seen no evidence of it so far, and it just makes sense that on a spike like that, XIV would blow up.
Yeah, I guess time will tell. I guess they'll investigate it more, and we'll find out more about that. But
I don't know if they will. I don't know. Do they have, when the SEC or the CFTC goes and investigates something, they have to have some hint of wrongdoing. Like, just because some guy dies, the FBI doesn't run around investigating. It's not just because there's a death. There has to be something shady about it, right?
right, right.
So, was there something shady about it? I'm not sure. I've not really delved into it myself to determine that, but I've not seen any evidence of it, and I've not looked a hell of a great deal either. But I'm
Yeah,
just saying.
I'm the same way. I don't know, but when people come up with very complicated conspiracy theories, I tend to think that probably the simplest explanation is the one that actually happened.
It's usually the case.
Yeah,
And I mean, one of the worst ideas out there that I've seen lately was that Credit Suisse themselves blew it up, as if that would be advantageous for Credit Suisse.
I
Now,
saw
as you
that
know,
too. I saw that too. Yeah, it's like,
yeah,
what?
I mean, come on, that was XIV was one of the prize cash cows for Credit Suisse and has been for years, right?
And it's not exactly giving them good publicity either.
No, exactly. Not to mention if they did something shady. I mean, can you imagine the world of shit those people would be in if they did something shady, causing the ruin of thousands and thousands of retail traders?
Right, right.
You know?
But
So
I think the risk of that was pretty clearly laid out in the literature.
yes, and it was, and unfortunately,
And so they covered their ass as far as I'm concerned.
yeah. Well, it looks like it to me, and I'm a legal professional, and it looks like they're pretty well covered.
I mean,
I
when I traded a little bit. I wasn't in it at the time, but I traded a little bit of it in Fidelity like a year ago, and
yeah.
Fidelity made me like sign all this additional paperwork just to trade this vehicle. Because they said, look, this is a risky thing, and you make sure you know the risks and all these disclaimers. I mean, I had to sign all this extra stuff just to trade that, and I'm sure everybody else does too. And that
Hmm.
legalese is there for a reason.
Yeah, exactly.
Mm.
Yeah. Yeah, I mean, it's a great idea, this instrument. Unfortunately, there were no circuit breakers inherent to the instrument. They just basically said, okay, we're just going to short volatility, and whatever happens, we'll just let the chips fall as they may. If I designed this vehicle, I would have taken X% of monthly proceeds and put it into hedges. Even if it was like 5% of monthly proceeds, just take 5% of the monthly proceeds and throw it into long calls on VIX or whatever, you know,
Buy some wings of some sort. Yeah.
of some sort, because you can't permit to have a short volatility position completely unchecked forever,
Well,
right?
I wonder. It was always interesting to me that you had SVXY and XIV, which were essentially the same thing. Like two products that are the same thing. It's kind of like TVIX and UVXY are like the same thing. Is
Yeah.
it? And so this really doesn't need to fill this void now because there already is something like it. We still have SVXY. So, but
I'm just wondering, has the subscription gone down in that instrument?
SVXY.
Yeah.
No, They've picked up a lot. It's picked. They're. Last I saw, there was like $500 million had gone into it.
Really?
Yeah, so people are still interested in shorting volatility.
Yeah. Well, I bought 10 shares. That contributed.
I bought a couple hundred, which I already got out of, so
Yeah.
I don't know.
Interesting stuff.
Yeah, because people are thinking, well, if you liked it at 100, you love it at 10, I think people are thinking that, which is a very simplistic way of thinking, but
But it's actually right.
right. Or if I could only buy 100 shares at 100, now I can buy 1,000 shares.
Yeah.
So
I mean, I think it's a cool instrument just because it permits everybody to go short equity volatility, um, SVXY or XIV, but you don't go running around selling volatility naked forever, you
well,
know?
there was an article in I believe it was Seeking Alpha where they were talking about, okay, so what's the right thing to do? You need to take out some of your profits every year and put them into cash, right? So that it's not just building up all the time and all your money's not at
You
risk.
wouldn't you wouldn't even need to do that. All you'd have to do if, for example, if you're dealing, well, unfortunately, XIV didn't even have an options market attached to it, which is kind of stupid. Um, am I correct there?
You're correct, yeah.
Okay. Whereas SVXY at least had an options market, so you could do something, even mildly reasonable and say, okay, every time I make 1% on this thing, I'm going to take 10 basis points and throw it into long puts.
And I did actually indeed talk to a guy who was long puts in SVXY,
Yeah.
to hedge himself, and he made out like a champ.
Yeah, of course. Yeah. He lost like possibly a few hundred or a few thousand instead of putting a huge dent in his portfolio, right?
Yeah, yeah. So
Yeah. There you go.
So, yeah, I mean, well, the other thing is like if you have like a VMIN declared a dividend of $10 and change, and so if you had traded it and you got the dividend as your income, you invest the dividend in something completely different, and then when it goes way down, you've still got that big amount of money on the side. So,
Yeah, well, you're talking about diversification now, and that's
yeah,
like, yeah, of course.
of course.
But I think maybe one good thing, if I can say there's a good thing about XIV blowing up, is it probably prompted a lot of retail investors interested in the volatility space to dig into it more and investigate more.
Right, try to understand exactly what's going on here
Maybe
because
more people are actually reading prospectuses these days.
either
Oh.
that or maybe they're actually investigating option strategies of selling options themselves as opposed to using a prepackaged solution. Who
Well, that would
knows?
be, if they can put in the work and the effort to it, it's far more rewarding if you can do it properly. And one of the objectives of this book I'm trying to do is make it actually accessible and make, simple language with principles and concepts that are easy to understand, that work, and you don't have to be a mathematician to understand it.
Well, I'll be interested in reading that because when they actually show the math behind some of this stuff,
Oh,
my eyes glaze
I'm,
over.
Me too. And like you were a professional options trader, and you probably couldn't grasp a lot of the math that is in this stuff because it's really heavy in math.
Yeah, like the Black and Scholes model, I've seen it portrayed on a chalkboard before, but
Yeah.
it doesn't. People can walk me through it, but it's not like I can do it myself.
Well, that's Nobel Peace Prize winning mathematics.
Right, exactly.
Nobody can be expected to understand that.
Yeah, exactly.
Yeah.
All right, cool. Well, we're still alive, and it's been a good week so far.
Yeah.
I'm really happy that I survived that February 5th thing, and I feel like I have a new lease on life from that. And I
Good.
survived the big one, and so let's have some fun this year.
Well, I think just keep at it. Be nimble and be small every day, and it'll add up. And if you're going into short equity volatility, there's obviously not a better time to be doing it when vol is this high. And in my portfolio, this short equity volatility position is becoming the big short, and it's going to pay out sooner or later.
Well, Well, and the other thing is that during the day, if things go way far in your favor, like they were today around 2 o'clock for some of us, take a little bit off. Take a profit here and there if it's because it might
Or
not
buy
stay
a
there.
hedge. Or
Yeah,
buy a hedge.
it might not stay there forever. Yeah, exactly.
Yeah. It's actually, I'd say it's even better to buy a bit of a hedge, you know?
Yeah, exactly. Because you're locking it in and you're taking the risk off.
Yeah. Yeah.
Cool.
Okay, well, thanks a lot for your time and your enlightenment again, Dave.
Thanks for coming on. I love it. And good luck this week, and I'll talk to you soon.
Okay, see you later, Dave. Have a good night.
You too.
Bye.
Bye. Thanks for watching, folks. Please check out the Facebook group, and we'll see you in the next one.